We now need to look at the funding for mergers and acquisitions. So when it comes to a merger or acquisition, the purchase consideration can either be settled in cash. So if the acquiring company wants to purchase shares in the target company, they can settle the transaction in cash, meaning that they pay the target company shareholders cash for their investment. The target company shareholders then disappear with their cash, and the acquiring company now holds the shares in the target company. Alternatively, the purchase consideration can be settled via a share exchange. So that means instead of the target company shareholders being given cash for their shareholding, they are given shares in the acquiring company. So they don't disappear. Now, after the acquisition, instead of having shares in the target company, they'll just have shares in the acquiring company. Or alternatively, the purchase consideration can also be settled with a combination of both cash and shares. So let's first look at this from the perspective of the acquiring company. If they have sufficient cash available to settle the purchase consideration and they decide to settle it in cash, that could obviously have a negative impact on the cash flow position of the acquiring company. Alternatively, they might not have sufficient cash available, but they still want to settle the transaction in cash. So they'll need to raise cash in order to finance the transaction. Now, obviously, if they don't have sufficient cash available and they need to raise the cash, they'll do this either by issuing new shares or they can raise debt finance. But regardless, this is going to have an impact on their capital structure. So you'll always need to consider their target capital structure and make sure, obviously, when they raise new funds, they should move closer towards their target capital structure. If they already have too much debt in their capital structure, then they'll have no choice but to issue new shares or to raise new equity finance. Then remember, the benefit of debt finance is debt is cheaper than equity. However, there's also a disadvantage of debt finance. Because interest and capital must be paid regardless of financial performance, debt exposes the company to financial risk. On the other hand, if the acquiring company decides to rather go the share exchange route, so they don't settle the purchase consideration in cash, instead they give the target company shareholders shares in the acquiring company. Now, obviously, if they do that, they're going to be issuing new shares. So they need to consider the effect of a dilution in shareholding for their existing shareholders. In addition to that, they need to consider what the target company shareholders expect when it comes to dividend payments. Guys, remember, before the acquisition, there would have been two separate companies with two separate dividend policies. But now, after the acquisition, there's only going to be a single dividend policy. So if the target company shareholders are given shares in the acquiring company, are they going to be happy with the dividend policy in the acquiring company? We also need to look at this from the perspective of the target company, and you need to consider the preference of the target company shareholders. Would they prefer to receive cash for their shares, or would they rather receive shares in the acquiring company? Now, guys, if they receive cash, that amount is going to be subject to capital gains tax. On the other hand, if they are given shares in the acquiring company, there won't be any immediate tax implications. However, if they do decide to eventually sell the shares in the acquiring company, then that amount will obviously also be subject to capital gains tax. But that will only happen in the future when they sell the shares in the acquiring company. Then, if they receive cash for their investment, there's obviously certainty with regard to the amount received. They'll know exactly what they are going to receive, and they get that amount in cash. On the other hand, if they are given shares in the acquiring company, they are going to be exposed to volatility in the acquiring company's share price, and that will obviously affect the value of their shareholding. If they are given shares in the acquiring company, they will have a continued financial interest, and there's obviously then a potential for increased earnings in the future and also an increase in the market value of their investment. Now guys, the shareholders of both the acquiring company and the target company are going to be interested in their financial standing both before and after any merger or acquisition. So they are going to monitor key financial indicators, and they are going to want to make sure that those key financial indicators improve as a result of a merger or acquisition. They will not vote in favor of a merger or acquisition if they anticipate that any key financial indicators will deteriorate as a result of the merger or acquisition. So it's important that you are able to calculate the financial effects of the merger or acquisition, as well as the method of funding on any key financial indicators. All right, so let's go and have a look at a lecture example so that this makes more sense. I want you to turn to lecture example 2.2. And in this example, the acquiring company is going to settle the purchase consideration in cash. However, they do not have sufficient cash available. So first they are going to raise the cash, and then after they've raised the cash, they'll use that money to settle the purchase consideration. Let's work through the information provided. Wendy Limited would like to purchase an 80% interest in the ordinary equity of Carroll Limited. So we've got Wendy Limited wanting to purchase 80% of the shares in Carroll Limited. The following information relates to the two companies. You've been given the earnings per share in cents and also the number of shares. The directors of Wendy Limited are planning to make a cash offer of 24 Rand per share. So we saw that above. The purchase consideration in this example is going to be settled in cash. So they will make a cash offer of 24 Rand per share. So we can use this information to calculate the purchase consideration. They are going to pay 24 Rand per share. Carroll Limited has 1 million shares in issue, but just be careful. They are looking at purchasing 80% of the shares in Carroll Limited. So you just need to multiply that by 80%. So that is the amount that Wendy Limited will be prepared to pay for the shares in Carroll Limited. And you can see the calculation just below. We have a purchase consideration of 19.2 million Rand. The directors of Wendy Limited are confident that pre-tax annual synergies of 800,000 Rand would be realized within the first year post-acquisition, and pre-tax integration costs over this period are expected to be 350,000 Rand. Furthermore, it's expected that Wendy Limited's earnings will grow by 7% over the next year, and Carroll Limited's earnings will grow by 5% over the next year. To raise the cash for the acquisition, remember above I told you they want to settle the purchase consideration in cash, but they don't have sufficient cash available. So first they need to raise the cash. So to raise this cash, they are going to issue 500,000 new shares. These shares are currently trading at 2,500 cents per share. The remainder will be paid from surplus cash reserves. So they do have some surplus cash, and this cash currently earns interest at a rate of 5% per annum. So guys, if you look at the calculation just below, we know that the total purchase consideration is 19.2 million Rand. They are going to issue 500,000 new shares so that they can raise cash in order to settle the purchase consideration, and the shares are currently trading at 2,500 cents per share. So By issuing 500,000 new shares, they will be able to raise 12.5 million rand. You were then told that the remainder is going to be paid from surplus cash reserves. So you can calculate the balance or the remainder, and this balance is going to be settled in cash. And that cash currently earns interest at a rate of 5% per annum. So you just need to be careful, guys. The company obviously has this cash sitting in a bank account somewhere where it's earning interest at a rate of 5% per annum. If they now use this cash to settle the purchase consideration, they are going to lose out on earning this interest. So they are going to forfeit this interest at a rate of 5% per annum. You'll see just now how that's going to affect our calculation. Then, we were told one more thing. You can assume that Wendy Limited's PE multiple will remain constant over the next year. So guys, how do we calculate the price earnings multiple for Wendy Limited? We take their share price, and we know that their shares are currently trading at 2,500 cents per share, and we divide by their earnings. And if you go up, Wendy Limited's earnings per share is 500 cents per share. So remember, that's how we calculate the price earnings multiple. You take the share price and you divide by earnings. So Wendy Limited has a price earnings multiple of 5, and that is going to remain constant over the next year. Let's look at the first part of the required. First, you need to analyze the effect of the acquisition over the course of 1 year on earnings per share. So guys, all you need to do is you need to look at earnings per share before the acquisition, earnings per share after the acquisition, and see if it has improved or deteriorated. So that's all we are doing. How do you calculate earnings per share? You take earnings and you divide by the number of shares in issue. Now, we already have earnings per share before the acquisition. There's the earnings per share for Wendy Limited before the acquisition and for Carol Limited before the acquisition. So we just need to calculate earnings per share after the acquisition. So first, let's focus on calculating what their earnings will be after the acquisition. Now guys, you have already been given the earnings per share for both Wendy Limited and Carol Limited. What you need to do is you need to multiply the earnings per share by the number of shares in issue so that you can get their earnings in total. So calculate the total earnings. Then please bear in mind, guys, Wendy Limited is only going to be purchasing 80% of the shares in Carol Limited. So when you are performing the calculation for Carol Limited, you are only looking at 80% of their earnings. So if we are calculating earnings after the acquisition, for Wendy Limited, their earnings per share before the acquisition is 500 cents, and they have 3 million shares in issue. So their total earnings are 15 million rand. So that is for Wendy Limited. And please note, guys, you were told that Wendy Limited's earnings are going to grow by 7% over the next financial year. So you just need to increase that by 7%. For Carol Limited, before the acquisition, their earnings per share is 600 cents. They have 1 million shares in issue. However, you need to multiply that by 80% because Wendy Limited will only be purchasing 80% of the shares in Carol Limited. So the total earnings is 4.8 million rand. However, that is going to increase by 5% over the next year. So you need to take that into account because in the required, you need to analyze the effect of the acquisition over the course of 1 year. So you need to take that growth in earnings into account for both Wendy Limited and for Carol Limited. Then, you were also told that there are going to be pre-tax annual synergies of 800,000 Rand, which will be realized within the first year post-acquisition. So we have some synergy benefits, and those synergy benefits will obviously have a positive impact on earnings. But just be careful, guys, this is pre-tax, so you just need to calculate the synergy benefit after tax. It's a synergy benefit, guys, so it is positive. It would be income. It would have a positive impact on earnings of the organization. We then have pre-tax integration costs over this period, which are expected to be 350,000 Rand. So once again, guys, this cost is pre-tax, so you just need to calculate the after-tax integration cost. And this is obviously a cost, so it will have a negative impact on earnings. Then lastly, remember, part of this purchase consideration is going to be settled in cash, and Wendy Limited currently earns interest at a rate of 5% per annum on this cash. So if the cash is used to settle the purchase consideration, then they won't earn this interest income anymore. So they will have lost interest, or they are forfeiting this interest on their cash. And that will obviously have a negative impact on earnings. So all you do is you take the cash amount of 6.7 million. They currently earn interest at a rate of 5% per annum, and you just need to get this amount after tax. Because remember, interest is tax deductible. So guys, we have then calculated earnings after the acquisition. Now we need to calculate the number of shares in issue after the acquisition. So before the acquisition, Wendy Limited had 3 million shares in issue. And in order to raise cash for the acquisition, they issued another 500,000 new shares. So after the acquisition, they will have 3.5 million shares in issue. Simple calculation. We can now calculate earnings per share after the acquisition. Take earnings after the acquisition, divide by the number of shares in issue, and guys, I'm just multiplying by 100 because this should always be in cents and not rands. All right. So we know, if we look at this from Wendy Limited's perspective, we know that their earnings per share before the acquisition was 500 cents per share. We know that earnings per share 1 year after the acquisition is 605 cents per share. We calculated that above. But there is one other comparison that we can also make. If there is no acquisition, their earnings per share will still grow by 7% over the next year. So just grow that by 7%. And what I'm trying to calculate is what the earnings per share will be in 1 year if there is no acquisition. So I can now compare these. I can see what the earnings per share is before the acquisition. I can see what their earnings per share will be in 1 year's time if there's no acquisition, and I can compare that to what the earnings per share will be in 1 year if there is an acquisition. And you guys can see that the shareholders of Wendy Limited will be better off as a result of the acquisition because there has been an improvement in their earnings per share. So earnings per share will improve as a result of the acquisition. Now I just have one variation that I wanted to bring in over here, guys. In this example, Wendy Limited did not have enough cash available to settle the purchase consideration, so first they needed to raise the cash. And in this example, they raised the cash partly by issuing new shares, and then some of it was settled using surplus cash that was currently earning interest at a rate of 5% per annum. So in this example, that is how they settled the purchase consideration of 19.2 million. Part was cash that was sitting in a bank account, and part of it was through a share issue. Now, I just want you to see how the calculation will change. So how does this calculation change? If they now enter into a loan agreement for 19.2 million Rand. So they aren't going to issue new shares, they won't use surplus cash, instead they are going to raise debt finance in order to settle the purchase consideration. So they enter into a loan agreement for 19.2 million rand at an interest rate of 8% per annum to raise the cash for the acquisition. Now guys, the only thing that's going to change in your calculation, if you go back, this is where we calculated earnings after the acquisition. The earnings for Wendy Limited will be the same, for Carroll Limited will be the same. The synergy benefits are the same, the integration costs are the same. Obviously now they won't have this lost interest on cash because they are now going to raise debt finance. They won't be using this surplus cash to settle the purchase consideration. So that is the only difference in the calculation. That's the same, that's the same, that's the same, that's the same. However, they now have interest on this loan. So there's a loan of 19.2 million rand with an interest rate of 8% per annum. And just remember, interest is tax deductible, so you need to multiply that by 72%. So you can calculate the earnings after the acquisition. Now, if we want earnings per share after the acquisition, we need the number of shares in issue after the acquisition. So before the acquisition, Wendy Limited had 3 million shares in issue. And if they are going to raise the purchase consideration with debt finance, they won't be issuing any new shares. So after the acquisition, they will still have 3 million shares in issue. So you can then calculate earnings per share after the acquisition. So guys, the only difference in the calculation, if they enter into a loan agreement, instead of issuing new shares to raise the purchase consideration, is now they are going to have interest on the loan, which will affect earnings. And in addition to that, the number of shares in issue won't change because obviously they aren't issuing any new shares. All right, so that's not part of this example. I just wanted you to see how the calculation would be different if they used debt finance instead of equity finance. Then, continuing with our example, I now want you to analyze the effect of the acquisition over the course of 1 year on the market value per share in Wendy Limited. So we need to calculate the market value per share after the acquisition. We already have the market value per share before the acquisition because we know that Wendy Limited shares are trading at 2,500 cents per share. So we have the market value before the acquisition. We now need to calculate the market value after the acquisition. How do we calculate the market value? Well, you were told that Wendy Limited's PE multiple will remain constant over the next year, and we saw that they have a PE multiple of 5. So we can perform this valuation using price earnings multiples. So you can see first I've calculated the current price earnings multiple for Wendy Limited. So the current share price before the acquisition is 2,500 cents, and their current earnings was 500 cents. So they had a PE multiple of 5, and that is going to remain constant. So we can now perform the valuation using price earnings multiples. How do we perform valuations using price earnings multiples? You calculate the value by taking earnings and multiplying by the price earnings multiple. So guys, on the previous page, we have the earnings. Here's earnings per share before the acquisition, earnings per share in 1 year if there's no acquisition, earnings per share in 1 year if there is an acquisition. Take the earnings, multiply by the PE multiple, and that will give you the value. So take the earnings per share from the previous page, multiply by the price earnings multiple of 5, and calculate the market value before the acquisition. So obviously you didn't need to perform that calculation because it was already given, but there's a proof. You can then also calculate the market value in 1 year if there's no acquisition, and the market value in 1 year if there is an acquisition. And you can see that the market value per share for Wendy Limited will improve as a result of the acquisition. So you can see the shareholders of Wendy Limited will be better off as a result of this acquisition because their market value per share improves and also the earnings per share improves.